a 27-year-old sits alone. Scrolling through home listings, at 11:47 p.m., a small 2-bedroom house appears on the screen. No swimming pool, no luxury finishes, no breathtaking view, just an ordinary home in an ordinary neighborhood. Then, his thumb stops. The price isn't shocking anymore. That's the frightening part, because somewhere along the way, $500,000 became normal. Not for a mansion, not for luxury, just for the chance to have a place to call home. Millions of Americans are experiencing the exact same moment, not because they suddenly became poor, but because the rules of buying a home quietly changed, and most people never noticed. For decades, owning a home wasn't just a financial decision. It was the symbol of the American dream. Graduate, get a stable job, build your credit, buy a house, raise a family, retire comfortably. That simple roadmap shaped generations. Parents believed it, schools encouraged it, banks promoted it, politicians celebrated it. It became more than advice. It became an expectation. But today, that roadmap feels like it's disappearing. Young professionals with 6-figure salaries are delaying homeownership. Couples with stable careers are losing bidding wars. Even families earning far above the national average are discovering that affordability doesn't mean what it used to. So what changed? Did homes suddenly become more valuable, or did money itself change? The answer begins with something most people rarely think about: interest rates. For years, borrowing money felt almost effortless. Cheap mortgages made expensive homes feel affordable. People weren't buying based on price, they were buying based on monthly payments, and that tiny psychological shift changed everything. Because when monthly payments become the focus, buyers slowly stop asking, "How much does this house actually cost?" Instead, they ask, "Can I afford this payment?" Banks understand this psychology extremely well. A lower monthly payment feels comfortable, even if it means paying hundreds of thousands of dollars more over the life of the mortgage. Most buyers don't calculate the total cost. They calculate today's comfort. And that's where one of America's biggest financial traps quietly begins. Then came another force, one that had nothing to do with families, and everything to do with money. Homes slowly stopped being just places to live. They became investments, investment firms, private equity companies, wealthy investors, and institutional buyers began looking at neighborhoods differently, not as communities, but as portfolios. Every house became another asset, another source of cash flow, another opportunity for appreciation. At the very same time, construction struggled to keep up. Demand kept rising. Supply stayed behind. Prices climbed higher, and suddenly, the average buyer wasn't just competing against another family. They were competing against wealth itself. That's when the American dream quietly entered a completely different game. The competition didn't become harder. It became invisible, because the family searching for their first home was no longer competing only against another young couple. They were competing against investors with cash, companies that could close a deal in days, investment funds that didn't need a mortgage, and when cash enters a market built for ordinary families, prices rarely move down. They move up fast. But here's what makes this story even more complicated. The real problem isn't just expensive homes, it's expensive money. Imagine buying a $600,000 house. Most people don't have that kind of cash, so they borrow. That's where the mortgage begins. A mortgage isn't just a loan, it's the price of borrowing money for decades. And when interest rates rise, the same house suddenly becomes far more expensive. Not because the seller changed the price, but because the bank changed the cost of borrowing. A payment that once felt manageable can increase by hundreds, sometimes even thousands, of dollars every month. Suddenly, the dream hasn't changed. Only the math has. This is why so many Americans today feel confused. They ask, "Why can't I afford the same house my parents bought?" The answer isn't always income. Sometimes it's timing. Many previous generations bought homes when prices were lower and borrowing money was cheaper. Today's buyers face something completely different: higher home prices, higher insurance costs, higher property taxes, higher maintenance expenses, and in many cities, higher competition than ever before. Every piece adds pressure. Individually, they seem manageable. Together, they reshape an entire generation's financial future. Then something unexpected happened. Social media entered the housing market, not directly, psychologically, every day. Millions of people scroll past luxury kitchens, million-dollar homes, perfect home offices, and dream backyards. The algorithm rarely shows ordinary houses. It rewards aspiration. Luxury gets attention. Attention creates desire. Desire changes expectations. Without realizing it, people stop comparing themselves to their neighbors. They compare themselves to creators, entrepreneurs, professional athletes, and internet millionaires. A normal home no longer feels exciting. Success starts looking bigger, more expensive, and always just out of reach. The pressure isn't only financial anymore. It's emotional, because buying a house today often feels like buying an identity. Proof that you've made it. Proof that you're successful. Proof that you're winning. And that's exactly why so many people stretch their finances beyond what's comfortable. Not because they need a bigger house, but because they don't want to feel left behind. The housing market isn't driven only by economics. It's driven by psychology, and psychology can become more expensive than the mortgage itself. Some people call it bad luck. Others blame the economy. But the deeper truth is that America quietly changed what a home represents. A house used to be a place to build a life today. It's also a financial asset. And those two ideas don't always work together. When an asset becomes more valuable, the owner celebrates. When a home becomes more expensive, the buyer suffers. That's the paradox. The same rising prices that make homeowners feel wealthier make homeownership harder for everyone else. But housing isn't the only thing becoming more expensive. Life itself is health insurance, car insurance, property taxes, utilities, childcare, college tuition, groceries. Almost every major expense has increased faster than many people's ability to save, which creates another hidden problem. Saving for a down payment becomes almost impossible. Imagine earning a decent salary. You pay rent, your car payment, insurance, student loans, credit card bills, subscriptions, food, gas, taxes at the end of the month. There's almost nothing left, not because you're irresponsible, because the financial system keeps pulling money in different directions. This is why so many Americans feel like they're running, without actually moving forward. Then comes lifestyle inflation, one of the most dangerous financial traps nobody notices. Your income increases, so your spending increases too. A nicer apartment, a newer car, more expensive vacations, luxury brands, premium subscriptions, everything feels deserved. But every upgrade quietly delays financial freedom. The problem isn't earning more, it's allowing every raise to disappear just as quickly. Meanwhile, your future home keeps getting more expensive. Years pass, the goal moves farther away. Then social media adds another layer of pressure. You open Instagram. Someone your age just bought a beautiful house. TikTok shows a creator renovating $1 million property. YouTube recommends videos titled, "How I Bought My First Home at 25. What you don't see is the family money, the business income, the equity, the lucky timing, or the debt behind the camera." You compare your reality to someone else's highlight reel, and comparison creates urgency. Urgency creates emotional decisions. Emotional decisions are usually expensive. This is exactly how millions of people end up buying homes. Not because the numbers make sense, but because they feel like they're falling behind. The housing market isn't only testing people's income anymore, it's testing their patience, their discipline, and their ability to ignore a world constantly telling them they're already too late. But while millions of families were trying to save for a home, another group was playing a completely different game. They weren't buying homes to live in, they were buying them to own. To them, a house wasn't a dream. It was a line on a balance sheet, a source of cash flow, a long-term asset, a hedge against inflation. When home prices rise, most families worry. Investors often don't, because rising prices increase the value of assets they already own. This is one of the biggest differences between consumers and asset owners. Consumers buy things that cost them money every month. Asset owners buy things they believe will produce value over time. That's why many investment firms entered the housing market, not because they loved neighborhoods, because they understood the numbers. Rental income, property, appreciation, tax advantages, leverage. These weren't emotional decisions, they were financial calculations. And that's where many first-time buyers unknowingly walk into a completely different competition. Imagine attending an auction. You have just enough money for one bid. Across the room, someone can buy 10 houses without blinking. The rules may be the same, but the game isn't. Then comes another concept most people never think about: leverage. Most wealthy investors don't buy assets only with cash. They use borrowed money strategically. If an investment grows faster than the cost of borrowing, their wealth can grow without using all of their own capital. When used carefully, leverage can accelerate wealth. When used recklessly, it can destroy it. That's why financial discipline matters more than financial confidence, because confidence makes people believe prices will always rise. Discipline prepares them for the day they don't. History has already shown what happens when that balance disappears. Housing markets can cool, interest rates can change, credit can tighten, speculation can fade. But one thing rarely changes. People who understand the financial system usually make decisions before the crowd notices what's happening. Everyone else reacts after the headlines appear. That's the hidden advantage of financial education. It doesn't predict the future. It helps you recognize patterns before they become obvious. And perhaps the biggest pattern of all is this. The wealthiest people rarely ask, "How much does this house cost?" They ask, "What role should this house play in my financial life?" Because a home can be many things: a place to build memories, a source of stability, an investment, or if purchased for the wrong reasons, a financial burden that follows someone for decades. The difference is rarely the house itself. The difference is the decision behind it. So, does this mean the American dream is over? Not exactly, but it does mean the rules have changed. For decades, building wealth was often straightforward. Work hard, save money, buy a home, watch its value grow. Repeat. Today, that same path is no longer guaranteed. Owning a home is still an incredible goal. But buying one simply because everyone else is can become one of the most expensive financial decisions of your life. The real question isn't, can I buy a house? It's, can I buy the right house at the right time, without sacrificing my financial future? Because wealth isn't built by owning the biggest home, it's built by making smart financial decisions consistently. Some people spend 30 years paying for a house, while never building meaningful investments. Others buy a modest home, invest consistently, build businesses, own stocks, create multiple income streams, and quietly achieve financial freedom. The difference isn't luck, it's financial structure. The people who build lasting wealth understand something that isn't taught in most schools. A house should support your financial life. It should never become your entire financial life. Because when every dollar goes toward one asset, you lose flexibility, you lose opportunity, and sometimes you lose peace of mind. The future belongs to people who understand assets, cash flow, and financial discipline. Not because those words sound impressive, but because they create options. Options to invest, options to start a business, options to survive economic uncertainty, options to say no to bad debt. Perhaps the biggest shift happening in America today isn't the housing market, it's the mindset around money. The old dream was to own a home. The new challenge is learning how to own your financial future. Because a home can give you shelter, it can give you stability, it can even become part of your wealth. But no house, no neighborhood, and no mortgage will ever replace financial knowledge. The people who thrive over the next decade won't necessarily be those with the biggest salaries or the biggest houses. They'll be the ones who understand how money actually works. Because in the end, the most valuable property you'll ever own isn't the house you live in, it's the financial decisions you make before you ever receive the keys.